Welcome back to the Money Lab. I am so incredibly pumped to have you here for week 11. You know, over our last few sessions, we successfully built out your containment field, that emergency vault we designed to catch life's, well, everyday curveballs. But today, we're moving way past the vault. We're going to mathematically tackle the massive, catastrophic financial threats to your future.
So, remember last week, we built your vault to stop those small dominoes. You know, things like a sudden car repair or a busted water heater. But today, we're staring down the gigantic dominoes. We're talking about massive, life-altering threats, ruinous medical bills, a permanent disability, a huge lawsuit. These are the unstoppable dominoes that are literally so huge they could wipe out your entire investment engine in a single afternoon. You just can't hold these up manually.
So, let's look at today's lab protocol. 1. Defining the gigantic domino. 2. The law of large numbers. 3. The ruin rule. 4. Term versus whole life. And 5. Your weekly risk audit. We're going to use cold, hard math to secure your future, so let's get right into it.
Starting off with part 1, the gigantic domino, the unstoppable risk.
Okay, we need to completely shift how we actually assess catastrophic threats. I mean, most people just view insurance as this annoying monthly expense, right? But here in the lab, we redefine it as a risk transfer protocol. You are basically paying a very small, known fee to force a multi-billion-dollar company to carry your massive, unknown risks. You're taking the crushing weight of that giant domino off your own shoulders, and you're legally handing it over to a corporation that's literally built to carry it.
Moving right along to Section 2, the law of large numbers. This is the math behind the catastrophe.
So you might be wondering, how on earth can a company afford to take on $1 million risk for just a few bucks a month? Well, it all comes down to predictability. We absolutely cannot predict exactly who is going to suffer a disaster. It could be me, it could be you. But statistically speaking, we can predict with 99% accuracy exactly how many people in a huge group will experience that disaster in any given year.
And here is how that 99% predictability actually plays out in practice. Think of it like a giant risk pool. Imagine 1,000 people, and everyone puts just one single dollar into a central pot. Okay, now you've got $1,000. Over the course of the year, let's say one person in that group suffers a massive $900 disaster. They take the money from the pot so they can survive. Your premium, it just joins this exact same risk pool. If you stay safe, your money protected someone else from ruin. But if disaster strikes you, the pool steps up and protects you.
So the absolute crucial point here is that you're trading a very small, manageable, known cost, your premium, to completely bypass a total financial wipeout. Because let's face it, without this protocol, one bad health diagnosis in, say, 2026, it doesn't just hurt your physical body, it completely bankrupts your entire future. There's really no way around it.
Which brings us to Section 3, the ruin rule. Let's figure out exactly what we should be insuring.
In the Money Lab, we strictly follow what we call the ruin rule. We basically map risks out on 2 axes: your likelihood of actually experiencing it, and whether or not you could afford the loss. The absolute golden rule here is that you must only insure things that fall into that afford to lose no category. You literally only insure things that would financially ruin you. So your health, your ability to earn an income through disability insurance, and of course, your life if you have dependents relying on you.
On the flip side, please, whatever you do, do not insure the $800 smartphone. We see this happen all the time. People buy these warranties and insurance plans for small electronics or appliances. You do not need insurance for that, because that is exactly what your emergency vault is built for. Insuring small things is just a mathematical loser's game. The house always wins those bets for sure. Keep your premiums for the real catastrophes.
And this naturally brings us to a highly specialized lab synergy. When you choose a high deductible, your monthly premium drops pretty significantly. Then, you use your already funded emergency vault to cover that deductible if a disaster actually happens. Doing this lowers your fixed monthly costs and easily saves you thousands of dollars in premiums over a decade. It's a total game changer.
All right, moving to Section 4, term versus whole life. Let's get the official lab verdict on this massive debate.
If you have ever sat down with an insurance salesperson, they've almost certainly pitched you whole life or universal life as this great investment vehicle. Well, the lab rejects this entirely. Whole life is kind of like a flashy, gold-plated shield. It looks nice, sure, but it's incredibly heavy, it's often 10 times more expensive, and it's completely bloated with these high fees that just eat away at your compounding interest. Term life, on the other hand, is just a simple, sturdy, highly affordable wooden shield. It does exactly what it needs to do to protect you and absolutely nothing more. The lab protocol for this is undeniably simple. Just buy a sturdy term policy that covers you for a set number of years. You really only need it until your investment engine grows large enough to make you completely self-insured. And because term is so incredibly cheap, you take all those saved premiums and you pump them directly into your index funds from our Week 7 session.
So if you take absolutely nothing else away from today, grab a pen and let it be this exact rule. Don't mix your protection with your production. Insurance is defensive protection. Investments are wealth production. When you try to mix them together, you just get a terrible, super expensive version of both. Keep your defensive shield totally separate from your wealth-generating engine.
And that brings us to Section 5, your weekly risk audit. Time for your lab task.
This week, we're doing a risk audit. I want you to pull up your declarations pages and walk through 3 critical steps. First, review your health and disability coverage. Ask yourself a really heavy question right now. If you couldn't physically work for the next 2 years, would your financial engine actually survive? Honestly? Second, check your liability limits on your auto and home policies to make sure a single freak lawsuit couldn't wipe you out. And third, if you have dependents, go out and get a simple term life quote.
And as you're doing this audit, look for the fat. If you're paying monthly premiums to insure tiny things like cell phones or washing machines, cancel them today, right now. Let your vault do its job. Then, take that newly freed up cash and use it to fix one massive gap in your disability or your life coverage. You've got to patch the hull of your ship before you sail any further out to sea.
So take control of your risk this week. Execute the risk transfer protocol so you can finally sleep soundly knowing those gigantic dominoes are being held up by someone else. Make sure to hit subscribe and join us for our next session where we are going to mathematically settle the ultimate housing debate, renting versus buying. Until then, I want you to really ask yourself, is your financial ship actually built to survive a massive storm, or are you just blindly praying for good weather?